Okay, today what we're going to do is, in response to a couple of comments that we've seen, is have a little look at Wyckoff. Now, I quite like the concept of some of the things that Wyckoff talks about, the idea of markets accumulating in certain areas, and then you can understand why these moves develop. Now, this is not to try and pick fault in what Wyckoff's principles are, but I feel that what it can often do, and this is twofold. One, it leads to this kind of perception that there are two entities within a market. Those who are in the knowledge, the smart money people who accumulate and then basically catch out all of the short-term retail type traders, mark the market up and then distribute the other way. Now, that when you read more and more about Wyckoff is not entirely the gist of it, and there is a lot more to this. We're not going to go into all of that depth today. Suffice to say, if you've got lots of people accumulating a position, so getting long, let's say, well, in that situation, once they are long, you now need some kind of initiative to actually drive the move again. And so to bring this on to how can you use this as a day trader, you then need to appreciate the structure. And so this is where generally Wyckoff is very easy to recognize. And this is my other kind of, not contention, but idea of looking at this. And with any kind of trading methodology, what you've got to do is you've got to say, okay, I can see this type of structure once it's happened. And that's a job of identification. You sort of go, right, I can see this. This is an accumulation. This is a spring. This is a distribution. Any of those different types of movements. But what you've really got to do in terms of making this a trade is then break these things down in terms of how do you actually trade this? What do you do in the accumulation phase? What do you do in the markup phase? How do you trade the distribution phase? And do you need to have certain specific rules and strategies for each different phase, and also be able to understand the transition from one to the other. And this, I think, is often where people not lose the value of it, but it's easy to see afterwards and yet not so easy to recognize in the moment. And this is all about process, and so much of day trading is about doing that. And also, I think where the greatest value comes in this is actually not being involved in the accumulation and distribution phase, but recognizing the shift away from those. That's where you get the greatest sort of bang for your buck on a trade, if you will. Because your job as a day trader, as a short-term trader, is not to position yourself and wait for a move to come. Leave that to those people who want to accumulate positions, and then if you want to sort of look at it from the point of view of this duality within a market. But your job is basically to say, right, if the market has now reached a low and is going to turn, the easy part of that move is the middle 80%. The bottom 10% and the top 10% is the hard bit. You can sit in those positions for a long time without ever knowing you're right or wrong. You want to be able to try and capture that middle 80%. So this all comes down to a little bit of understanding process. Now, you go and look at the sort of basic image that I've got, gives you what I call a sort of model of that process. And so what you're trying to do is then break down each part of this and understand what happens within each phase of it. One of the key kind of concepts and principles of Wyckoff's analysis and sort of teachings is that no two patterns are going to be exactly the same. And this is the whole idea of using a model of what goes on. You're not trying to pinpoint exact movements, but what you're trying to do is you're trying to break the moves down into phases and say to yourself, what's going to happen here? How do I identify that from the way a market trades, rather than just going at the basic principle of, that must be the spring. And you either run into the risk of being predictive without knowing that it's coming, or behind the curve in that you see the spring happens, the move starts, and then you look back and go, aha, there was the spring. So it's about understanding each stage of this process. So what you want to be looking toward, something much more along the lines of this. So this was a reasonably recent one in gold, middle of September. And you can identify these phases within this. But where your value comes when you're looking at anything like this is having a process for each phase. So within these accumulation areas, this leads you to a more sort of scalping based style. Until you get any movement out of what is becoming an established range, you can't really do anything directionally. Equally, the spring part of the move, the hard bit with anything like this is as you create the spring, that's going to look a lot like a continuation move. So one of the key questions that you've got to be asking yourself, and it's about having a kind of set of questions for each different phase. As you get to that point that could potentially be the spring, and you can see one at the bottom and at the top, you need to be quite clear on what needs to happen to identify this not being a continuation. So this then comes down to bringing in other skills of understanding what a continuation move looks like. For a continuation move, you would want to see the market push up and then it holds higher, and then you start seeing buying coming in again if this is to the upside. That would be a continuation. If you don't see that, you can now start thinking maybe this is a spring. And as you fall back into that distribution area, if we're looking at this upper spring up here, then you can start to play this to the downside. The other aspect to this is understanding where to access your trades. And this is something that I think is lacking generally in people's analysis like this. That what they look for is, the easy concept. And if you go down, if you've read anything on this, the easy concept is, well, you buy with all of these people and you sell with all of these people, the smart money people. The difficulty there, risk-wise, and your ability to leverage this trade up is not easy. You're sitting in a very wide range. That upper range in oil just up there is nearly 100 ticks wide. Get in a position in the middle of there, even on a one lot, you're risking sort of $1,000 swing on P&L without ever knowing that you're right. So more to the point here, the way that you make this work for you, and this is what you got to think about as a day trader. Once you've got this situation, you're looking for your access point once you move away from this zone. So you then need to be very clear on what the order flow is like in each phase. This is where a price ladder comes in, and we'll perhaps do another video on this, on these breakout moves, what the price action needs to look like as you get the break that allows you to say, yes, now the move's on, now you can actually extract something from this. So that's where you really gain the greatest amount of value from Wyckoff. It's not about identification and trying to be like larger time frame participants. It's about recognizing the shift and the moves between phases. That's where you can suggest to yourself and you can spot the change in movement, the change in momentum within the market. This is what gives you a huge amount of value, and this is also where you can leverage your positions up. Like I say, we'll do a video on this at some point in the future anyway, so watch out for that one, how to play a clear breakout. If this has been a helpful one and you want to see that breakout trade that we do in the future, click on the notifications button, subscribe to the page. This way you'll get that, it will get it announced to you as this comes out fresh off the press, and you'll be able to see how you can use order flow, how you can use a price ladder to execute on a breakout using a distribution Wyckoff type pattern. We'll see you all very soon.